The sudden appreciation of the Japanese yen is dropping a silent bombshell on the global financial market, especially on U.S. stocks. The famous carry trade, which has sustained large investment movements for decades, is threatened. Investors often borrow in yen, attracted by Japan's low interest rates, and invest in assets with higher returns, such as U.S. stocks. Now, with the yen rising, these investors need to quickly sell their positions to pay off debt, putting pressure on markets. This sudden reversal in the carry trade is no ordinary move. It is a sign of profound and unpredictable changes in the global financial market. Enjoyed this content? Then don't miss out on the other videos on my channel. I'm sure you'll find something that catches your interest. And if you haven't subscribed yet, make sure to hit that subscribe button and turn on notifications. That way, you'll stay updated with all the new content and help the channel grow even more. I'm counting on you. The yen's appreciation is exposing the vulnerability of Western markets to Eastern monetary policy. The interconnectedness between global markets has never been more evident. The strength of the Japanese currency is not only a reflection of local politics, but a warning about how adjustments in one economy can resonate in other parts of the world. The massive sale of assets in the U.S. to cover yen debts shows how these global financial connections can cause economic earthquakes. Investors who believe that the U.S. was an island insulated from these fluctuations are learning otherwise, painfully and immediately. The impact goes beyond the stock market. The Bank of Japan's policy of raising its interest rates after years of an extremely loose approach is forcing a reassessment of several global financial strategies. This move surprised many investors, especially those who were betting on the continuation of low interest rates. The end of this loose monetary policy cycle in Japan may be triggering a perfect storm, with consequences not only for stocks but for bonds and other assets. What was once seen as a safe source of cheap money has become an expensive liability, and now many are rushing to minimize losses. This shift in the Japanese market also puts additional pressure on Western central banks, most notably the Federal Reserve. With the global economy in a state of fragility, the decisions of a central bank in one region of the world are strongly influencing expectations elsewhere. The Federal Reserve may be forced to rethink its own interest rate policies to deal with the knock-on effects of this shift in Japan. Any sharp move could trigger more volatility in financial markets, leaving investors on constant alert. This raises a troubling question. Are we about to see a new era of global financial instability? Finally, the carry trade is just the tip of the iceberg. The real question is how this upheaval will affect global economic dynamics in the long run. We are seeing the first signs of a financial realignment between East and West, and what is at stake are not just stocks or bonds, but the very structure of global finance. The world is about to enter a new phase of uncertainty, and what once seemed like a stable investment strategy may now turn into a minefield. With the growing pressure to repatriate capital and adjust monetary policies, the interconnectedness of markets could become a double-edged sword for investors around the globe.